Welcome back, everybody. We're more than halfway through earnings season, but there are some big names on deck today. For this edition of Earnings Exchange, we are looking at Lyft, MSG Entertainment, and Chipotle. Let's start with Lyft. It's up more than 3% ahead of the print, but has fallen 24% over the past year. Analysts are watching how Omicron impacted demand last quarter and whether incentives are helping to attract drivers without hurting the bottom line. Here with the story on Lyft is our very own Dom Chu. And Dan Genter has our trades today. He's the CEO and CIO of RNC Genter Capital Management. Welcome to you both. Dom, start us off. What are we looking for with Lyft?
All right, so you mentioned, Kelly, that the 24% decline over the last year for Lyft shares. By the way, that's outperforming Uber, which has lost 36% during that similar time period. So let's start off now with what the estimates are. Lyft is expected to come in with earnings per share of roughly 9 cents. Total revenues just about $941.5 million. So the results could show both profits and revenues will be better year over year, increases over those same time frames. Now, the last 3 years, a roller coaster ride for sure for the ride-hailing company. Even with the pandemic and the subsequent recovery, the near and term, medium term, at least momentum has been to the downside for the better part of the last year. Investors will be looking at some of the more other ancillary metrics, like the number of active users or riders, as well as how much each of those riders generates in revenues per rider. Lyft is also a stock that can be very volatile around these earnings releases. And just to give you an idea of that, over the last 8 quarterly reports, Lyft has traded up 4 times and down 4 times, with an average move up or down of 8.5%. And Kelly, right now, the options market is currently pricing in a move of up or down 14.5%, just to give you an idea of just how volatile it could be. So this is very much going to be a story, not just about the current or the previous quarter ups and downs, bottom line and top lines, but also what the forecast and outlook will be for Lyft and its riders.
All right, so we could see some big movement on this front. Dan, I think you've said in the past you're not a huge fan of their business models. What are you looking for? What would you do with the stocks?
Well, I think you have to like the stock, Kelly, at this price. I mean, there's going to be, as was just mentioned, there's going to be a tremendous amount of volatility. It's certainly getting caught on all sides by changes in what's happening in the overall economy, what's happening in PE compressions, the shift from growth to value. I mean, it has all of these obstacles. But that having been said, you know, the Lyft has done well, at least compared to its comps, even though on a revenue basis has actually struggled, because Uber did a much better job of pivoting in 2020 to go into Uber Eats, to being part of the stay-at-home delivery model. I mean, Lyft pretty well just took it on the chin. Now, what's happening, though, where I see an advantage for Lyft is that they're primarily domestic. I mean, they're U.S., they're Canadian. We're clearly opening up here. Even in California, mask mandates are about to come off. I mean, they're going to be a very pure play as we start to reopen. So when you look at the range of where it is now, this is it's been a darling growth stock. It's a little out of favor right now, but it's trading at a 23 PE. So if you can have good numbers, you know, the street's really looking for earnings to be up over 60%. But if you can see decent numbers for fourth quarter, you get some reasonable guidance, you know, then this is a stock that really could join the rest of the growth crowd and even be a 40 PE.
Interesting.
So I think right now it's a buy.
But Dan, are you looking at 2023 earnings for that PE though? Because it looks like if we look at the next 4 quarters or so, the PE would be much higher.
Absolutely. I mean, I'm not talking about a double. You know, we're not looking from 23 to 44, but certainly, you know, look, you could see a pop of at least 15% in the stock from where you are now. And you just need some reasonable news. If they don't really disappoint, you know, the big if is going to be how bad did they get hit by Omni in December? And if that looks reasonable, I think you get a decent pop in the stock.
Very interesting. And from what Dom said about the options market, could happen in a moment or in a day. Right. We'll see. Be sure to catch Lyft co-founder John Zimmer discussing these results as well on Squawk Box tomorrow around 8:45 a.m. Eastern time. Dom, thank you very much. Dan, you stay right there. Let's move on to Madison Square Garden Entertainment, the spinoff of MSG that counts its concerts and non-sporting events. It's a quintessential reopening trade, but the shares are down nearly 30% in the past year. Our audience knows this is a Charlie Babrinskoy favorite pick. Julia Borston is here with the story. Julia, what will you be watching for tonight?
Well, I would say one thing I'm not going to be watching for is comps with last year. And that's because last year, the live event space was so quiet. It doesn't make sense to look at comps. What it does make sense is to look at the impact of Omicron on this past quarter to get a sense of how much people changed their behavior because of Omicron. And then any guidance. That's really where investors are going to be looking to understand bookings and also whether different acts are scaling back or whether they're still committed to their performances going forward. Another key thing to watch here, Kelly, is betting. MSGE does have partnerships with a number of the big sports books, such as DraftKings. So we're going to have to see what they say about the potential to grow that business.
All right. So, Dan, if you're tactically interested in Lyft here, does MSGE tickle your fancy the same way?
Yeah, I think so. And I think Julia is absolutely correct that there are no comps. So there's nothing really to compare it to. So all you can really look is at the bookings and the shows they have planned for the next 6 months, which actually looks very strong. You know, we manage money here for a lot of people in LA in the entertainment business, and I can tell you they're back out on the road. So the venues are opening up, performers are performing, they're making money again, they want to be out there. And right now, you know, what you're looking at in the show bookings actually looks very, very good for the next 6 months. So, but I think the play here, which is why we actually like this stock, is that all of those things are going to be very positive. Their revenue, you know, should get back up to be, you know, a little below where it was, you know, certainly in 19, but well back on its road. But the play is it's an asset play. I mean, this stock is selling below book value. And I think you really have to look at it just as an asset play right now. And so it's a strong buy with, you know, with, again, reasonable news that we can see. I mean, we're not going to shut the economy down again. These shows are going to go on, you know, as the saying goes. And they're just very cheap right now.
All right. MSGE, the spotlight is on them in this next report. Julia, thank you very much, our Julia Borston. All right, finally today, Chipotle, one of the rare names with pricing power in the face of rising costs. Shares are still down 17% this year, but it's been a monster performer. 0 sell ratings on the street heading into this report. What are the key metrics to watch? Kate Rogers is all over it. Hi, Kate.
Hey, Kelly. Well, the key metrics, of course, will be same-store sales and also margins, how this inflation is impacting the restaurant operating margins here. So you mentioned pricing power. Chipotle is, as mentioned, one of the rare names that really does have it in this space. And last quarter, we heard from executives that they were really confident that they could pull the pricing lever even further, and customers likely wouldn't pull back if needed. They noted higher costs in beef, in freight, and they were raising menu prices slowly and just slightly, and really not seeing, as mentioned, consumers pulling back. They also raised prices back in June to cover higher wages. So that's going to be another thing to watch here. A close second will be its digital sales. That's always very important with Chipotle. It was about a little less than half of all sales last quarter. And another thing here is its loyalty members. Last quarter, it had just under 25 million loyalty members. Kelly, it's one of the fastest growing programs in the space that we track. And digital and loyalty really allow it to kind of switch over and rely more heavily on digital sales when, you know, it's having some staffing challenges in restaurants. It's interesting you mentioned 0 sell ratings. I think that's because a lot of investors do have confidence that this is one company that can really continue to absorb these price hikes.
All right, Dan, and we're out of time, so let me boil it down. You would still prefer something like McDonald's to Chipotle here?
Yeah, that's correct. I just think they're a little bit more priced to perfection. They're going to have to grow at 30% to maintain this PE. If the stock goes down any, I'd buy on weakness as a growth play, but I would hold right now and see what happens with the earnings.
All right, guys, thank you. We'll leave it right there. Dan Genter joining us with our trades today. Our Kate Rogers covering